Good morning, all. Obviously, we've heard, and we've obviously seen in the press, that it's been a very eventful year so far for Australian politics, but we can equally say it's been quite an eventful year for financial markets and the global economy. If you think back to January, we might have been enjoying the cricket and the summer days here in Australia, and it seemed like heady optimism was seen everywhere around the world. S&P 500 was up another 7% after gaining about 20 or so percent after Trump's election through 2017. Emerging markets were growing very strongly, and that was flowing through to their equity markets, and all seemed well. And then we came to February, and we saw quite a significant change. One wages number in the US effectively led to a narrative shift with rates going up in the US and expectation they would continue to rise quite dramatically. And equally, that sort of flowed on to the rest of the world. We saw there effectively a tension being built. No longer it felt as though growth could have no consequence with regards to inflation and policy. Now inflation was coming back and rates were going to have to rise as a consequence. So we see this real, I guess, new narrative, and that's what we're seeing for 2018, that there's going to be this tension between growth and inflation, and also between policy, both arms of it. So being the central banks and monetary policy, and versus that being fiscal policy, with governments, particularly in the US, really sort of leading the way and sort of changing, I guess, the narrative as to what governments are willing to do to try and stir growth. So this year is going to be quite an interesting time, and what I want to do today is give a brief overview, I suppose, as our key themes for the global economy, and then we'll move to Australia and contrast what we see as being sort of the, I guess, major sort of factors that are at play in our economy against that global view. So just to start with, I think it's quite useful sometimes just to think about, I guess, the evolving kind of momentum we're seeing in the global economy, and the PMIs which we receive from a number of different producers around the world really give a good sense of how that momentum has built over the last couple of years. Since kind of the low point of about 2016, we've seen this continual sort of acceleration momentum across the world, and that's been true of our major trading partners as well as kind of the more developed economies around the world. And it has felt as though, as has continued over the last year or so, that more and more confidence has been built into this sort of trend, and it's expectation that this will continue. One of the key factors behind, I guess, the sure footing of this trend that we have seen so far, and the expectation that it will continue, is the breadth of the growth we are seeing around the world. It is now the case that, unlike what we saw sort of in the early years after the GFC, where we had one or two economies doing well, but others not so being the case, and therefore offsetting each other, now we see everyone effectively growing quite strongly across the world. This is true of the developed world, particularly US and Europe. Obviously for Europe, they've had a very long kind of weak growth period, and now the consumer and investment is really coming to the fore, and particularly for countries like Germany and Spain, we're seeing very strong outcomes and quite drastic improvements in their labour markets as well, which is providing, again, a surer footing for growth going forward. Equally for the US, we did have sort of a down year in 2016, but since then, in 2017, the growth really was above expectations, and now with the tax reform package that was passed at the end of last year, actually more importantly, the spending additions that they actually added on when they did the spending authority about a week or so ago, that's really going to supercharge growth over the next 18 months or so, because effectively talking about 1.5% of GDP of new spending being put into the economy in an 18-month period. So that's going to lead to sort of growth probably around about 3% in 2018, and then probably about 2.5% in 2019. I'll just note there with the US that 2.5% figure is very much loaded into the front half, and this is really, again, where we see one of the best examples of this tension between growth and inflation and policy coming to the fore. We actually think growth in 2019 will slow really quite drastically as we see the Fed's rate increases really start to impact market sentiment and term interest rates. So we are looking for 3 rate hikes from the Fed this year, and another 2 in March and June 2019. And it's our expectation that will see the US 10-year around about 3.5% by the end of March next year. And that is a much higher level than we have seen for about 4 or so years. And just the expectation that that might actually continue on from there and see higher rates again will likely really heavily impact both sentiment and also the financial conditions that are at play in that economy. And that's really what's going to lead to that softer growth outcome. Now, across in the developing world, there's a number of quite interesting dynamics at play. It feels as though India is in a much stronger position now, and they're becoming, I guess, the momentum provider to the economy, to the global economy, as China's economy starts to slow. But the thing to note about China as well is that they're undergoing quite a fascinating sort of period in their sort of a history, in the sense that they're looking to try and reshape the economy, focus much more on the quality of growth rather than the quantity. So they're quite happy to see a slower pace of growth, but given the development that is still undergoing in that economy and the desire to restrain debt there, it also means that the mix of growth is changing quite a lot. This has quite a lot of opportunities for Australia, which we'll talk about a little bit later. But really, it's around sort of not only being able to provide commodity exports to to China and part of the rest of the region, but also in terms of the tourism and education we can provide as exports as well, and other sort of commodities, sort of rural commodities, as well as kind of manufactured rural goods as well, which really fit into their sort of higher standard of living and their desire to sort of buy sort of foreign goods. And this is going to be a key positive for Australia. We'll talk a little bit more about that later in terms of the momentum it's giving our economy and the potential opportunities for investment there. But I just want to highlight against that sort of growth story that you'll see at the bottom line there for Australia that we've really been struggling to really break away from about 2.5% growth. And this is really a sub-trend outcome. We generally regard trend growth for Australia as being about 2.75%. So it's not that far away, but it's still, in terms of the mechanics of the economy and I think how people are experiencing or feeling about the economy, it is quite a way away. Now, it is fair to say that part of this kind of underperformance was because of the end of the mining investment boom that has had a significant negative impact on growth for a number of years. That is now ending, and really what's the narrative, the key narrative behind the 2018 and 19 view in our minds is really this cautious consumer. What we see from, I guess, the history post-GFC is that generally we've seen the consumer be really unwilling to go out and spend on additional items, discretionary spending. So where it has consumption growth used to run at sort of 3.25% or 3.5% before the GFC, it's really been running around sort of 2.5% pace ever since, and that's likely to continue going forward. Now, in thinking about this slide, I was kind of wondering as to whether it's actually a good idea to call it the cautious consumer or perhaps the restrained or restricted consumer. So what you can see here is that the consumption growth story is very tied into incomes. The fact that incomes are not rising as significantly as they have in the past is meaning people are feeling a bit concerned about their family finances and therefore unwilling to go out and spend. The major sort of story, I guess part of that story is really what's happening with wages. Now, if you read the press yesterday or today, following the labour force release for the month of January, it's probably see that we actually reached a historic record. This was the 16th consecutive month where we've seen positive job gains in this economy, which is the longest run we've ever had. Equally, if we look at the annual growth rate for employment, it's running about 3.3%, which is twice what we're seeing with population growth. So these are very strong numbers. But at the same time, wages growth is well below its historic average. And it's not just about one particular industry or one particular state. It's broad-based across the nation. The major story in part of this is partly due to, the change in the way of the distribution of jobs that are being created. So whereas we used to have a lot of mining jobs at a high income level being produced, now we're looking at much more sort of retail, tourism, education areas, which are all coming at a lower level. So there is, I guess, a change over there and a rolling down of, the average wage, so to speak. But equally, there's still, cost pressures there. And there's also a more structural sort of a situation at play as well, which is regards to the degree of labour market slack we still have, despite the employment gains we have seen. We don't really see this all that much in the unemployment rate. So that's running at about 5.5%, which is only about half a percentage point above what we regard as being full employment. What we can see here from this graph is the level of underemployment. So those who are working part-time but would like to work more. And equally, there's been quite a large shift outside of the labour market as well, notably amongst men who have actually chosen to leave the labour force rather than seek other employment. All these people are actually able to work a lot more than they actually currently are. And that actually provides additional supply, which is actually now meeting demand, and meaning that we don't get those wage pressures coming through as we are starting to see in the US. And this is really a key reason as to why we believe that we're not going to see wages growth accelerate through the next couple of years, and equal then why the consumer will likely remain restrained, and also why CPI inflation will also remain at the bottom end of the target range for the RBA and keep them on hold through that period. The other, important factor with regards to the consumer is household debt. Now, unfortunately, this is an area where we really do lead the world. I think we're second only to Switzerland. And it's quite a different dynamic, obviously, to what we've seen in a lot of developed markets, such as the US, where you saw a very significant reduction in their debt-to-income ratios. We're really sitting at sort of record highs after the last couple of years, where we've had quite a strong investor demand in the housing market, which has been obviously using credit to actually go out and buy properties, and that's brought us back to the previous peak and above it. The thing to note about this graph as well is that little red line that runs below the black. That's just trying to show you what the debt level is net of offset balances. So you can effectively think about this as debt less that sort of cash that people have at hand if they were to face a rainy day, losing their job or needing to meet additional expenses. It's actually quite a limited amount of buffer, so to speak. And that means that they're actually very much thinking about that total level of debt and wanting to pay that down. And it's again another reason why they're less than willing to actually go out and spend on additional discretionary goods, which they don't really need necessarily right this time. That's a nice way to, I guess, then move into the housing market, which is obviously undergoing quite a significant change at the moment. Last year or so, well, 2016 and 2017 was effectively a second wave of house price growth, following on from the first, which came through in sort of 14 and 15, but was then met by macroprudential policy and slowed back. We are, we believe, entering a new period of house price growth where we're likely to see it running between about 0 and 5%. Now, the reason why I give that sort of range is that it really matters not only by city, but also by suburb. You'll have pockets of major cities which still do see price gains because they're in high demand and there's not a lot of turnover of stock. Generally, this is going to be the quintessential family home on a nice block in the suburbs. Equally, at the same time, you have new supply coming through, which is actually leading to, I guess, a greater supply than demand for apartments in certain pockets, and they're potentially going to see price declines. The degree to which that comes through will really depend on what we see in terms of foreign demand, which has come off quite considerably, and also the impact of macroprudential policy on what we see for investor demand as well. To give you a sense, I suppose, of the scale of macroprudential policy and its impact that we've seen so far, really the first wave was, I guess, not as significant as the next because the second wave is effectively built on the first. So the first was focused on trying to limit the amount of credit growth that we're seeing in the economy to investors, and that definitely did support that slowing of momentum. And that's now been, I guess, strengthened in the sense that the APRA now wants to see credit growth materially below 10%. But equally, the shift away from interest-only loans has now meant that we're starting to see a lot of investors having to reconsider their financing and start paying principal and interest, which is obviously going to then draw down on their cash and equally a greater amount of their income. And again, means they have to focus on the investments they're holding for the long term rather than day-to-day consumption. And again, is another reason as to why we would likely see a softer pace of consumption growth going forward. But the other part of the story here is because we are seeing this change in the way that APRA looks at risk in the economy, and the RBA is of a similar view, that does also mean that the banks overall are repricing the way they structure mortgages as well. And so it does mean that for interest only, for investors, and equally investors versus owner-occupiers, you're seeing different rates. And it's a very new thing for the Australian consumer to actually understand the implications of and look to actually reassess their family finances and move forward with that. There will be people who do actually in a situation where they do have to sell the property because they can't actually meet those cash flow situations, and that could, in some pockets, lead to additional supply which needs to be worked through softer prices for a time. On the matter of supply, I guess more broadly, we're not terribly concerned that we're going to end up in a situation like the US was in the GFC with excess supply of a very large scale. Overall, we've seen the supply that has been created in Australia, particularly in Sydney and Melbourne, it's been quite broad-based across the metro area. And equally, a lot of it's different in nature in the sense you've got sort of one-bedroom apartments, twos and threes, and some townhouses as well. So it means that a number of different markets can actually come as a demand base and purchase those assets, which therefore means that we should have a more settled and more stable market going forward. Brisbane is maybe a question mark here that they are seeing a new supply which is very different to what they've had in the past with a lot of apartments in the CBD. Equally, the population growth for Queensland and Brisbane in particular is much weaker than we're seeing for Sydney and Melbourne. So there's less foreign migrants moving in and also less interstate migration coming into that location, which means it'll take a lot longer to work through and it'll be a lot harder to rent out apartments versus Sydney and Melbourne, and equally then you might potentially see more weakness, a longer period of weakness for prices. Interestingly enough, if you actually look at the Brisbane price detail, it's looking flat rather than sort of down. So it's not a case like Perth is where you've actually seen outright declines. It's more just an absence of price growth. So far we've covered sort of consumption and housing, which obviously are two key factors for our economy. I just wanted to, run through a few, of the opportunities and, some of the sort of more potential sort of risk factors we're seeing for the economy going forward before concluding. To start with, around mining investment and non-mining investment. Mining investment is really getting to the end of its sort of negative impact on the economy. So that's a definite positive for growth. We don't have to offset that. And that means that we will see the benefit of net exports all the more so because they're not just offsetting the loss of investment. Equally, for non-mining investment, we're still not really seeing that fire. So we are seeing some, increase in non-residential construction, which is associated with needs in the health sector and also for tourism. But we're not really seeing the same pass-through into equipment investment. And that really means that that's being held back and is not providing a very meaningful sort of support for growth at this present time. And that therefore means that we're really relying on what we're seeing in terms of net exports and also public demand to be that sort of, component which gets us to trend growth or potentially above it because the consumer is sort of sitting there and looking to assess conditions before wanting to actually increase their spending. With regards to sort of net exports and then potential implications for investment, really, for Australia, one of the sort of key swing factors is going to be around what we see with service exports. So I was talking about this a little bit earlier, that we have seen, a very significant opportunity develop in Asia as their rising middle class comes through and looks to demand a product and service mix that they haven't looked to actually be able to have in the past. And that is something we can definitely benefit from. But we haven't necessarily outperformed anyone else in the world in terms of sort of gaining that sort of dollar coming through into our economy from that area. And there is a need to invest in infrastructure that actually provides services for these sectors, and equally to try and continue to improve the linkages that we have with the region if we are to see the maximum benefit from this area of the economy, global economy. And really, a lot of this will also depend on our competitiveness in a dollar sense, and for that, we really need to focus on where the Australian dollar is going to be. It has been our expectation for some time that we would see the Australian dollar move down to the low 70s. Indeed, last year we were thinking it might even go as far as the high 60s. Really, this was built on this expectation we'd see higher interest rates in the US. That would weigh on our Australian dollar, and equally we would see commodity prices coming through and actually acting as a weight on the Australian dollar as well. We haven't really seen either of those factors really come through and have as much of an impact as we would have thought, and therefore it's remaining a bit sticky at that sort of 79, 80 cent level. Now, if this does continue and we don't see that fall back to 72 cents through this year, then that's going to be an additional kind of burden for our export sector, particularly around tourism and education. And that's a reason as to why we might see more subdued growth than we would otherwise do if we were to see that sort of, as expected sort of move in the currency. And on a TWI basis, for the currency, it really sort of depends on what's happening with those other currencies around the world. But by and large, that's holding up as well, which means, again, our competitiveness on a global perspective, not just against the US, is being sort of impacted there. So just finally, just on the RBA. So I mentioned earlier that we are expecting the RBA to remain on hold through 2018 and 2019. And core to this view really is thinking about what the implications are for the consumer. If the consumer continues to run at a sub-trend pace, then you can expect that inflation will remain at the lower end of the RBA's target range. And equally, if we continue to see macroprudential policy holding back the housing market and keeping that on a surer footing, then there's not those financial stability concerns for the RBA either. And that's a really strong justification for them to remain on hold through that period. They can hopefully then allow, as I was mentioning, the Fed to raise rates around the world and see the Australian dollar fall. And equally, if we're really lucky, then we'll see the global momentum continue, and then we'll get that benefit from net exports without having that sort of a need to actually try and stoke growth through fiscal policy or those kind of opportunities. So just before we head into Q&A, I'll just, sum up. We are in a situation where the global economy is by far and away in its best position it has been for a long period of time. And there is significant opportunity for Australia, but we need to tap into that opportunity. It's about building relationships with the Asian region and making the best use of our skill base and our capacity as a nation to provide those service exports and also manufactured goods, as well as commodities. At the moment, we're not really doing that, and we're seeing sub-trend outcomes, and this is why we're needing to see, or this is sort of a situation we need to try and, redress and look to try and improve the momentum we have in the economy.